If you found this guide helpful, please consider liking and subscribing for more clear financial insights. We are about to embark on a short journey. The destination is clarity. The stock market often feels like an exclusive club, guarded by complex jargon and dizzying charts. It is presented as a domain for geniuses and gamblers, a place where fortunes are won and lost in the blink of an eye. This perception is a disservice to what the market truly is. It is not an unsolvable puzzle. It is a system built on simple human principles anyone can understand with a little patience and guidance. This short guide promises to strip away the noise. It will not offer you hot stock tips or a secret formula for instant wealth. Instead, it will provide a foundational understanding. We will explain the stock market in plain, simple language. At its most fundamental level, the stock market is nothing more than a vast, organized marketplace where people buy and sell small ownership pieces of publicly traded companies. Imagine a colossal supermarket. Instead of selling apples, milk, and bread, this supermarket sells tiny slices of businesses. These slices are officially called shares or stocks. When you purchase a share of a company like Apple, Ford, you are not just buying a digital certificate. You are becoming a part owner of that business. You own a minuscule fraction of its buildings, its patents, its brand, and its future profits. It is a profound concept when you pause to think about it. Companies choose to sell these small pieces of themselves for a very important reason: to raise money, also known as capital. Building a factory, developing a new product, or expanding into a new country requires enormous sums of cash. By selling shares to the public, a company can raise this capital without having to take on massive debt from a bank. In return, the people who buy these shares, the shareholders, hope to benefit from the company's future success. The stock market, then, is the critical infrastructure that facilitates this exchange. It is the grand meeting place that connects companies in need of funding with individuals looking for a place to grow their money. A trade is the most basic action in the stock market. It is the simple act of a buyer purchasing shares from a seller. For every person who clicks buy on a stock, there must be another person somewhere else clicking sell. The exchange's job is to find these two people and facilitate the transfer of ownership at a price they both agree on. This process once involved frantic shouting and hand signals on a crowded floor. Now it happens almost instantaneously through vast, interconnected computer networks. The price at which the trade occurs is called the market price, a dynamic value that reflects the current consensus of what a share is worth. When you decide to trade, you will typically place an order through a broker. A broker is your intermediary, a company or digital app that gives you access to the stock exchanges. Think of them as your personal agent who takes your instructions and carries them out. You might place a market order, buy or sell immediately at the best available price. This is the quickest way to execute a trade. Alternatively, you could use a limit order. You specify the exact price you want. Your trade only goes through if the market price reaches your limit. Let's consider the journey of your order. You open your brokerage app and decide to buy 10 shares. You place a market order. Your broker receives this instruction digitally. The broker's system routes your order, maybe directly to a major exchange like the Nasdaq. Or it could route to market makers who hold inventory of shares. The system instantly scans for the lowest price offered by sellers. Once it finds a match, the transaction is executed. The shares move into your account. The cash moves to the seller's account. This whole sequence happens faster than a blink. The force that governs all stock price movements is a concept you learned in your very first economics class: supply-demand. Supply refers to the total number of shares available for sale at any given time. Demand refers to the total number of shares that investors want to buy. When demand is greater than supply, more people are trying to buy than sell. The price is pushed upward. Buyers compete by offering slightly higher prices to entice sellers. Conversely, when supply exceeds demand, sellers outnumber buyers. The price is driven downward. This simple mechanic is the engine. But what's the fuel? Information, emotion, storytelling. A company's price changes because collective opinion about its future shifts. Positive news, such as blockbuster earnings report, launch of a revolutionary new product, upgrade from a respected analyst can dramatically increase demand. Investors grow optimistic about future profits and are willing to pay more for that potential. Influx of buy orders with fewer sellers propels the price higher. Negative information can do the opposite, increasing supply as investors rush to sell. Disappointing earnings report, major product recall, new government regulation, broader economic downturn can create a wave of pessimism. Investors fear a dimmer future and rush to sell to avoid losses. Flood of sell orders, hesitant buyers, price falls. Ultimately, a stock's price is a story. It's a weighted average of hope, fear, greed, meticulous analysis. That explains short-term volatility. Over the long term, the story usually follows performance. One of the most compelling reasons people invest in the stock market is the potential for significant long-term growth. Over long stretches of history, the stock market as a whole has generated returns that have outpaced most other types of investments, bonds, savings accounts. This is not a guarantee of future performance, but it reflects a fundamental economic truth. As economies grow and companies become more profitable, the value of owning those companies tends to increase. Investing in stocks lets you participate in broad economic expansion and grow your wealth faster than inflation. Another powerful benefit is ownership and compounding. When you buy a stock, you're not just betting on a number. You're part owner of a real business. As that business succeeds, you can be rewarded in two ways. Appreciation. The stock price rises as the company grows. Dividends. Companies pay shareholders part of their profits. Reinvesting dividends to buy more shares creates compounding. Small investments growing into much larger ones. The stock market also offers liquidity, an advantage over investments like real estate. If you own a house and need cash fast, you usually can't sell it in minutes. It can take months. With publicly traded stocks, you can sell on any market day and often have cash in a few business days. Finally, investing is more accessible and affordable than ever. Today, online brokerage firms and mobile apps let you start with just a few dollars. Many platforms have removed trading commissions, lowering barriers for new investors. The result? Stock ownership is open to almost anyone with a bank account and an internet connection. This guide is a calm port in that storm of information. A quiet conversation about a powerful economic engine, built to give you confidence from genuine comprehension. The most significant and unavoidable risk of investing in the stock market is the potential to lose money. A stock's price is not guaranteed to go up. It can, and often does, go down. In a worst-case scenario, a company can go bankrupt, rendering its stock completely worthless, and your entire investment in that single company could be wiped out. This is not a theoretical danger. It is a real possibility that has befallen investors in countless companies throughout history. The potential for growth is always tethered to the risk of loss, and anyone who tells you otherwise is either naive or dishonest. Another major downside is short-term volatility. Stock prices can swing dramatically from day to day or even minute to minute, often for reasons that seem to have little to do with a company's underlying business performance. This constant fluctuation can be emotionally taxing and stressful. This volatility becomes particularly dangerous if you are forced to sell during a downturn. If you invest money that you need in the short term, a sudden market dip could force you to sell at a loss to cover your expense, turning a temporary paper loss into a permanent real one. Beyond the inherent market risks, there are also costs associated with investing that can eat into your returns over time. When you sell a stock for a profit, that gain is typically subject to capital gains taxes, and these taxes can take a significant bite out of your net earnings. It is crucial to be aware of the full cost structure of your investments, as even seemingly small fees and taxes can compound over the years and substantially reduce your long-term wealth accumulation. Finally, the sheer volume of information and misinformation presents a serious risk. The internet is flooded with financial advice, stock tips, bold predictions. It is incredibly difficult for a beginner to distinguish between sound, evidence-based guidance and reckless speculation disguised as expertise. This can lead investors to make poor decisions based on rumors, hype, a fear of missing out. Furthermore, our own psychology can be our worst enemy. The powerful emotions of fear and greed often compel us to do the exact opposite of what is rational. to buy enthusiastically at market peaks and to sell in a panic at market bottoms. After weighing the potential for growth against the undeniable risks, we arrive at the central question: is investing in the stock market worth it? For most people with long-term financial goals, the answer is a qualified yes. It is not a get-rich-quick scheme, nor a risk-free path to prosperity. It's one of the most effective tools for growing wealth over long periods and preserving purchasing power against inflation. Over time, money in a standard savings account likely loses value as costs rise. The stock market offers a reasonable chance to outpace inflation. The key to answering this question is your personal financial situation and your time horizon. Investing is a long-term game. If your goal is decades away, like retirement, the market can be a powerful ally. If your goal is short-term, like a down payment next year, the market is likely too risky. Investing is not all or nothing. See it as one part of a broader financial plan. Start with a solid foundation, paying off high-interest debt, building an emergency fund, 3 to 6 months. Keep that fund somewhere safe and accessible. A high-yield savings account, not the stock market. Only after that safety net exists should you invest money you won't need for at least 5 years, preferably longer. Investing is worth it if you have the right mindset. Patience, discipline, realistic expectations. It's worth it if you're willing to learn a little up front and commit to a steady, consistent strategy. It's not worth it if you're seeking overnight riches, prone to panic, or investing money you can't afford to lose. The stock market is a tool, very helpful when used correctly, dangerously harmful when used recklessly. The choice and the responsibility lie with you. Welcome to your starting point. We began this journey with a simple promise: to demystify the stock market. We have seen that it is not a mystical casino, but a structured marketplace for owning pieces of real businesses. It is a system that allows companies to raise capital for growth, and it offers individuals a chance to participate in that growth over the long term. We have explored how trades are executed, how prices are determined by supply and demand, and how those forces are fueled by the stories we tell ourselves about the future. The market is a mirror reflecting our collective hopes and fears about the economy. We have also acknowledged the two sides of the investing coin. On one side, the potential for wealth creation, the power of compounding, and the accessibility modern technology provides. On the other side, the risks, the potential for loss, the stress of short-term volatility, and the psychological traps that can lead even smart people to make poor decisions. Understanding both pros and cons is the hallmark of a mature investor. The path forward doesn't require you to be a financial wizard. It requires prudence and discipline. Start with an emergency fund. Define your long-term goals. Diversify through low-cost index funds. Invest consistently over time. Cultivate the patience to let your plan work. The goal isn't to beat the market or find the next hot stock. It's to use the market as a tool for your financial objectives. If this guide helped, please like and subscribe. Your investing journey doesn't need to be guesswork or anxiety. With a foundation and sensible principles, you can move from nervous spectator to thoughtful, confident participant. Thank you for joining us. May your financial journey be steady and successful.